How to think like a trader. Hey everyone, welcome to Risk Premium. I'm Charles, and today I'm going to give you 10 ways traders think about the market, their positions, and the players around them. We're not just talking about any traders, we're talking about successful, profitable traders in contrast to those who consistently lose money. Without further ado, let's jump into 10 things traders think about that make them successful. Number 10. Traders think they know nothing. A good trader constantly reminds themselves that there is so much they don't know. Bad traders think they know everything and will constantly be surprised when things don't work out the way they expect. Smart traders are looking for ways their ideas could be wrong, constantly challenging themselves to see the flaws in their own thinking. The ancient philosopher Socrates was credited with immense wisdom because instead of proclaiming what he knew, he merely admitted that he knew nothing. This is how good traders need to think. For example, instead of thinking, this stock is going to rise because product sales will hit a record next quarter, a good trader understands they cannot be certain about what the sales are going to be, and therefore their attention shifts to things that could help to change their assumptions. What warning signs could they look for that would tell them the product sales are not going to meet their expectations? Perhaps information from suppliers of raw material, or evidence from retail stores that confirm actual purchases. Good traders think they know nothing for certain and constantly seek to validate or reject their assumptions. Number 9. Traders think about the opportunity cost of their money. A good trader understands that there are many possible trades to make at any moment, but each dollar can only be used for one trade at a time. The trader must therefore consider the other opportunities that their money can be used for, and shouldn't make a trade that makes less profit than an alternative opportunity. For example, if the trader's money is sitting in an investment safely making 10% each year, they shouldn't take any other trade unless the expected profit is more than 10%. Whatever is that trader's best, safe alternative for their money at any time represents the opportunity cost of their money. A good trader knows their opportunity cost and constantly deploys their money in the best trades available to them at any time. Number 8. Traders think losses are inevitable. Bad traders expect to win with every trade and are therefore surprised when they sometimes make losses. Good traders, on the other hand, know to expect occasional losses. Smart traders understand that the market is outside of their control, and their only job is to win more than they lose, not to stop losing entirely. In fact, many good traders intentionally take many trades that will almost surely lose, as long as the reward for winning on just one of the trades is so great that it will make up for all the other losses. This is especially the case with options traders, who sometimes create trades that will lose money week after week, until one day, the trade makes back all of the losses plus a large profit. Traders who think that losses are inevitable will not be surprised by anything that the market throws at them. Number 7. Traders think in terms of risk and reward. Profitable traders understand that every asset can go up or down, and that the probabilities of moving higher or lower can be different. Taken together, the potential increase in the price, multiplied by the probability of the increase happening, represents the potential reward of betting on the asset. On the other hand, the potential decrease in the price, multiplied by the probability of the decline happening, represents the risk of betting on the asset. It takes skill and practice to estimate how high or low an asset can go and what the probabilities are of each outcome, but getting it right is something that traders take very seriously. Good traders only make bets when the potential reward outweighs the potential risk. Number 6. Traders think the market sends signals with prices. A lot of people think the market is just a place for buyers and sellers to meet and transact. But good traders understand that the market's purpose isn't just to get transactions completed, it's to clarify the prices at which transactions happen. In the stock market, this price is publicly available for all to see, and it sends a valuable signal to all different parts of the economy. When stocks are valued highly, they send a signal to entrepreneurs to start new companies in that sector or industry, which increases competition and makes the economy more efficient. When stocks are valued low, they send a signal that companies might be better off breaking up into pieces and selling them off individually, which discourages the formation of large companies and may slow the economy. Good traders use the signals from stock prices and pair them with signals about the economy in order to make better decisions about their trades. For example, if a trader thinks the economy is running at an unsustainably high pace, then high-priced stocks may be overvalued, as the company will eventually slow down, so the trader may want to sell. But if stocks are highly priced and the economy still has room to expand in a sustainable way, it may be a good idea to keep owning those stocks. Outside of the stock market, such as in the commodities market, prices also send valuable signals. When the price of oil is low, for example, it sends a signal to oil producers to stop drilling wells, which lowers oil supply. Low prices also encourage people to use more oil, which increases demand. When supply gets low enough and demand gets high enough, traders then place bets on a recovery in oil price. Smart traders use the signals that prices tell them about assets and combine them with other information in order to come up with sound trading strategies. Next up, number 5. It's an important one, but first, hit that like button if you haven't already, because that helps out with the YouTube algorithm. Also, subscribe to this channel and turn on all notifications, because that way you'll be sure to see the next video when it's released. Now for number 5. Traders think about the risks of their entire portfolio, not just the risks of each individual position. This is important. Bad traders think of each of their trades as individual positions with their own risk and reward characteristics. This is true, but it's an incomplete picture, and good traders know how to broaden their scope of understanding. Good traders look at the overall characteristics of the portfolio, including the ways in which different trades interact and relate to each other. For example, buying several stocks in the same sector, such as technology, will create a portfolio in which all of the trades move in a similar fashion. This portfolio will have a similar risk and reward profile to any one of the individual trades within it. On the other hand, buying stocks across multiple different sectors assures the trader that their entire portfolio has different characteristics than any single trade within it. Good traders determine how the addition of a new trade will impact their entire portfolio's risk and return profile instead of just looking at the trade on its own merits. Number 4. Traders think about the worst that could happen. The worst possible thing that can happen in a trade is that it goes so badly the trader loses the ability to make new trades. The most direct way this happens is by losing all of the money the trader has to trade with. Preventing this from happening is always on the mind of a good trader. Smart traders prepare for the worst by having a plan to exit positions before losses become unsurmountable. For many traders, this involves implementing what is called a stop loss, or an automatic sell order that gets triggered if an asset they've bought dips below a certain price level. By using stop losses appropriately, good traders are prepared for the worst. Number 3. Traders think good news can be bad news and bad news can be good news. Bad traders often get hung up on the news flow about assets they trade, eager to buy when there's good news and sell when there's bad news. But good traders know that news alone can be misleading. After all, what moves the price of a stock, for example, isn't whether the news is good or bad. It's how good or bad the news was relative to what was expected. Say, for instance, a popular new clothing brand is about to release its earnings figures. Everyone expects sales to be up from the previous quarter. However, when it's revealed that sales increased 20%, the stock plummets. Why? Rising sales is of course good news, but the market was probably expecting even better news. For traders, news is only good if it's better than what was expected. Likewise, bad news is only bad if it's worse than what was expected. Smart traders understand the difference and don't get caught wrong-footed by buying or selling incorrectly with every news article that comes out. Number 2. Traders think other people stretch the truth or spread rumors. Naive traders take everything they read at face value. If a penny stock company says it's going to be worth $10 billion someday, these unsavvy traders take them at their word and buy blindly. Good traders understand that everything they hear and read has to be taken with a grain of salt. These smart traders are always asking themselves, what is the motivation of the person expressing a particular opinion? Do they have something to gain by convincing me that a certain trade is a good or bad investment? Even other traders can be the source of misinformation. There is a phrase used to describe traders who try to convince you to take the same trades as themselves. It's called talking their book. Their book or portfolio of trades would perform better if everyone bought what they bought and sold what they sold. Traders who talk about their book are only trying to convince others to make the same trades they've made. They're not necessarily trying to give anyone accurate or useful information. That's why smart traders think other people are not always completely honest and act accordingly. Now for number 1. Traders think that no one is responsible for their success or failure except themselves. A bad trader will find someone or something to blame when their trades go wrong. Maybe they blame the management of a company they invested in when the company doesn't perform as well as they expected. After all, it's the company's fault it's not doing well, right? Of course, but it's not the company's fault that the trader decided to buy the stock. If the trader had done better research, they could have uncovered clues that the company's management team was unlikely to perform at the desired level. Good traders know that ultimately the performance of their trades is up to them and only them. No one else is responsible for the trader's positions. No one else can be held accountable when the trader loses money. This can be a tough pill to swallow for some traders, but when it's embraced, it's actually quite liberating. It means that traders are 100% in control of their own destiny. And that is one of the greatest things about being a trader. What are some of your ideas about how to think like a trader? Leave them in the comments below. I try to respond to every comment, so let me know what you think. Also, if you're a returning viewer, you may have noticed that this video has a different focus than my previous videos. If you prefer this more general discussion about trading, let me know. Or if you prefer the detailed analysis on certain topics like my previous videos, let me know that too. I've been really encouraged by the responses to my previous videos, so I do intend to keep making content like that. Thank you to everyone who liked and commented on my previous videos. If you haven't seen my previous videos, click here to check out one that other viewers liked. And don't forget to like, subscribe, and hit the notification bell so that you're made aware when new videos are posted. That's all for now, and happy trading!